What's up, everybody? Will I owe taxes when I sell my South Carolina home? That is the question we are posing to all of you today. We're going to go over my favorite subject, taxes, today. We won't go as deep as I would love to go.
We are not tax attorneys. We are not CPAs. We have nothing like that. So
we're starting off the show telling you we are not CPAs. We are not attorneys.
Listen, turn off now.
Yeah.
But we do want to advise you on the things that you need to know when you do need to talk to a CPA. These are overall concepts that are so important if you're thinking about buying or selling here in South Carolina, because every state is so different.
Yes, and taxes are the largest expense anyone will have in their lifetime. And I think that just needs to sit with everybody for a second, because there are lots of ways to, and I don't want to use the word avoid, because that's not what it's about, but we are trying to make sure we pay our fair share. But if you go through the tax code, the IRS tax code, most of it is geared towards telling you how you can not avoid paying lots of taxes. And so if you do the right things, and that's what we're going to talk about tonight. And we've taken it down to how it affects you here in Myrtle Beach and just in general. So in case you're not sure, I'm Frank Harita. This is Tiffany Harita, and we are Carolina Crafted Homes. And I'm excited for this topic. Yes. Are you ready? I have strict instructions to stay on the notes today. Tiffany has told me so.
I don't love talking about taxes, though. They're so frustrating. I know everybody's feeling probably this year. We just are taxed on everything every time we turn around. So
that is true.
Well, let's talk about the taxes here for property. So we're talking about not property taxes that you pay every year, but the taxes that you pay if you sell a property. Mm-hmm. And it all depends on what type of property you have. Is this your primary residence? Are you married? Are you single? Is this a short-term rental property? We have a ton of those in our area. Is it a long-term rental property, or did you inherit the property? Do you live in the state? Do you live out of the state? All of these things will factor in on if you pay. And this is the frustrating thing about taxes and the tax code that I think everybody is just like so frustrated by. It's so confusing to everybody to know what's going on and how to know what is like you should be expecting for taxes, because it's so dependent on so many different variables.
And our goal tonight is to help you make sense of all of it. And also, I would say that I'm going to take a quick second here just to say that it is really important in life for you to have a great team around you. You know, we're always talking about how we want to help people in real estate, but we're just trying to help people in general. We don't care if you call us and ask us a question about taxes and that's all you want to hear from us. If we can help, we'll point you in the right direction when it comes to real estate. But my goal is to help everybody understand that you need a good CPA. You need a good attorney. You need certain people around you to have a team. That's what I mean when I say team, to make sure you make good decisions and avoid paying all this money that you may not have to pay.
Well, I think the worst thing is when you sell a property or do anything really, and you're not expecting a big hit, and then you go file your taxes and you're told you owe this huge number, and you're like, where did that come from? It came out of nowhere. So that's what you want to avoid, is the surprise huge tax bill. And we even have certain things at closing that you need to know of that we have our sellers sign off on if they're not South Carolina residents, because it is different. And if you don't know about it ahead of time, you're hit with this big expense at the closing table that you might not be prepared for. So let's break it down super easy, though. This, again, we're not going to be the like total tax accountant CPA, but we're going to break it down into a way that everybody can understand based on each situation that you might be in. Of course, each one you can dive even deeper, but we're going to also give you some tips and tricks on things that might be able to lower the amount of taxes that you owe. So do you want to get kick-started? We've got a little graphics.
We've got graphics tonight we're going to show because it makes it easier.
Yeah.
I know a lot of you might be visual, and we're going to talk through everything, but we're going to have visuals up so that you can see as well while we're talking, because I think it's really important to help all of you. And I've also put together a little tax cheat sheet. If you're interested, let us know. If you want the cheat sheet at the end of the show, you can text the Tiffany or I cheat sheet, and we'll make sure that you get it. Give us your email. In the meantime, though, tell us where you're watching from. I'd love to know where you live, and if you own a home, is it primary? Maybe text us one, for primary residence. Do you own an investment home, or do you not own here yet, but it's something that's a goal of yours? So maybe like 1 primary, 2 investment, and 3 you're hoping to do it in the future. I'd be interested to know. All right, so let's put up number 1 here. I think this is the first one. Yeah.
So this is, let's just say this is your primary residence. Let's just keep it simple to start. But we're married, so you get a little bit extra benefits.
Trip down memory lane. Okay.
We finally got married after 7 years. And we did our taxes.
She has to throw in the 7 years before we got married piece.
As long as I can.
All right.
So the first year we did our taxes, I was like, man, we should have gotten married sooner. There's so many benefits to filing jointly. So this is one of them. And you want to go through it? So the amount that...
It's up to $500,000.
Right.
Is the exclusion that you can't be taxed on.
And $500,000 isn't the sales price.
That's right. That's the key.
Yeah.
So this isn't sales price. This is gain.
Correct.
On the sales price.
So on here, there is an example.
Yes.
So let's say that you bought the home for $350,000, okay? And then you put $50,000 into it while you lived there. Maybe you added new HVAC, new roof, a pool. I don't know, a pool for $50 would be cheap, but let's say you did that. And then you sold it eventually for $825,000. So you also have $55,000 in closing costs. So that's your commissions,
correct.
All of the things like that you go into selling a property, the attorney's fees, all of that. So
that's right. Now try not to fall asleep on us here, but we're going to go through some quick math. So your basis or your cost offset of $455,000, the approximate gain is $370,000. So if you qualify for the $500,000 exclusion, federal taxable capital gain may be 0. So what should you know? Well, many primary home sellers owe no federal cap gains tax. The exclusion can wipe out a very large gain, and the tax discussion is about gain, not the full sales price, as we said. So it's over and above the sales price, and then above that. So you wouldn't have to pay on the $500,000 that you make on the home.
Yes. So, but make sure, some people might think, oh, it's just whatever's the difference between what I originally bought it and what I sold it for, but it's a little more detailed than that.
Yeah.
But it's different if you are single. So let's put the next slide up because, let's say that you bought a similar home for $250,000. Again, this is just your home. You're not married. You're single, or just filing.
So you bought it for $250,000. Mm-hmm. You sell it for $675,000. So you have improvements plus selling costs of $35,000. So the quick math is the approximate gain is $390,000. And so the exclusion, the $250,000 exclusion may apply if you qualify. The approximate remaining federally taxable gain is $140,000.
Yeah. So again, maybe before you sell, go get married. I don't know.
I'm not gonna. I actually am gonna promote getting married.
Okay.
That is the way to go all day long.
It might cost you in other ways, but so Nancy Mace actually put a bill through. It's not been approved, but there is a bill currently in legislation that she is proposing to wipe out all capital gains for your primary residence.
That's right.
So when you sell it, there's no cap. There's nothing like what we've just talked about. You get to keep the money.
And that's for what you would pay over and above, because if you have a gain over the 500 or the 250, if you're married or single, you would pay a particular tax on the
Right.
on that amount. We could go into that. It's not worth it right now, but there is a taxable event on that, and that's what her bill is discussing. If you go over and above that 500, and the reason why that bill is coming to fruition is the last time this law was put into place was 1997. And values of homes have gone up quite a bit since 1997. And so what they're trying to say is, hey, that's not really fair. Everybody's going to pay some tax because a lot of people are making more than 500,000 if they file jointly, or if they're single at the 250. So they're trying to get that eliminated, anything over that, and at least raise the number. But it looks like they're wiping it out completely, trying to.
Well, that would be awesome. But let's talk about what qualifies as a primary residence, because it's a home that you've lived in for 2 years out of the last 5. And some people think that it has to be 2 consecutive years, but it actually doesn't. It can be any 2-year period within the 5 years.
Yeah.
So you can live in it the first year, rent it, then live it in the 4th year, rent it, then sell it. But if you're doing this every couple of years,
you have to wait 2.
But if you keep doing it over and over again, it's going to be a red flag, and they might not give you the primary resident exemption. So
I didn't know that.
Yeah.
But it says you have to wait 2 years. So as long as you wait the 2 years, you should be fine.
Well, that's what is not black and white.
But I don't.
Tax laws are black and white, right?
Yeah, I mean, I could see somebody. That's a lot, though. More power to you if you want to.
Doing it every 2 years, it like red flags. Bless you. Frank is getting a little sick. Hopefully not. We're about to go on vacation. So FYI, when we're not here next week, we are on vacation, but we're thinking about y'all. So, but yes, that would be considered your primary residence. Now, let's go to the vacation condo, because we have a lot of that in our area, and that is done very differently. So let's say that you have an Airbnb type property. That's what we're talking about now.
Yes.
So you bought it for 220, you sold it for 340,000.
So it looks like it's $120,000 difference. But you're selling cost improvements are 25.
And then you have a gain of 95,000. So what is taxable of that 95, Frank?
Well, it says no primary home exclusion if it was not your main home. Federal long-term cap gains tax may apply, and South Carolina's deduction may reduce state tax on qualifying gains. So what do you need to know as the viewer? Well, the vacation homes do not get the automatic primary home break, so that doesn't apply to this. The sellers may still get favorable state treatment on qualifying gains, and second homes are a different animal, which we know very well.
Yeah. Yes.
So do we want to talk about what that tax rate is?
For second homes?
Yeah.
Well, let's go to the, the next is rental properties, which kind of, I guess, is not really a second home. But yeah, go ahead and you can talk about that, Frank. The second homes.
So this is a rental property example. So
this is more of a long-term rental, not a short-term vacation rental property.
Okay. I mean, but depreciation could apply to both.
Correct.
So do we want to explain depreciation?
In a nutshell, go ahead, Frank, without getting too crazy.
Yeah. So any property that you purchase is on a depreciation schedule, meaning there's things that need done to property while you own the property. And so they lose value over time because they need things done to them. So it's figured out on a 27.5-year scale, I think. I think it's 27.5 years. So you can claim depreciation on a property that you own. Again, I'm not a CPA, but you can claim depreciation on a property you own, and that is a tax break for you. So there's also something called bonus depreciation, where you can condense all those years of depreciation you would normally write off a little bit each year. You can compress it into just a few short years, and we're not going to get into the details on that tonight.
We do have a video on our channel about cost segregation studies and bonus depreciation, so check out that video. We do go into details on that, but that's a good way to save taxes each year. That's not about when you sell the property, but it's while you own the property.
That's right.
But it could affect you when you sell the property.
That's what I was going to get to. So if you claim depreciation, especially bonus depreciation, because you're condensing it into a couple years, you get you get a lot of help on taxes. So if you sell that property, you have to maybe give some of that money back that you got from savings.
They're going to get you any way they can.
That's right. So
now to defer that, you could do a 1031 exchange.
That's right.
I mean, like you can defer it as long as you want, I guess, but at some point you're going to have to sell the property and be taxed. But,
sure, but it just keeps continuing until you pull it out.
And you can upgrade your property.
Yes. A 1031 exchange is essentially just allows you to take money out of an investment property and just completely move it to another. It's called a like kind exchange or Starker exchange, where you can take that money and move it to another property. You have to identify the property within 45 days, and you have 180 days to get it done, to close. And so
the biggest thing is
you don't pay taxes on it until the very last property you roll it into and you pull money out. You sell that. You have a sellable taxable event.
But the biggest thing is you need to tell your agent and your CPA, your attorney, before you list that you plan to do a 1031 exchange. That needs to be disclosed. And also, you are not allowed to touch any money from that transaction. If you touch the money from it, you cannot do the 1031 exchange. It has to go to your exchange agent. That needs to be set up ahead of time. And
a qualified intermediary.
Yeah, and it's not that every CPA will do that. There's very few in our area that will actually be the intermediary for you. So that's something you need to plan ahead and not wait till you're under contract and like, oh my gosh, I need to get this figured out. You need to get the steps in process before you list your property.
But this is, if you have rental, there's so many advantages and there's so many ways to do something like this, but a 1031 exchange is a very powerful tool. If you own investment property and you don't know what this is, you need to go and ask your CPA or you need to look it up. There's no reason not to use this if you have investment property and you're going to sell it and you want to just keep rolling it into the next property.
I think the only
save you so much money
thing is the timing of it. You don't have unlimited time, like Frank said. So it's really hard. You can't really, sometimes you can go under contract on the buy side with a contingency that you can sell your 1031 property in time. Not a lot of sellers might accept a contingency like that. Maybe on the oceanfront market right now, because it's so many, such a buyer's market, maybe they would consider that. In a strong market, usually they wouldn't. So you need to consider that, because you might find a new property that you love and you need to get rid of your other one to get this one, but you got to do that first and hope this one's still there. So the timing of it can come into play.
These are really, the other reason why these are powerful tools is that the average American in their lifetime will pay $500,000 in taxes.
Jeez.
That's huge. And so you should be trying to figure out any advantage you can to pay less in taxes. And this is one of those powerful ways if you get into investment property.
Yeah.
Okay.
So let's go into, do we do the rental? Okay.
So you bought it for $300,000, you sold it for $5,000, and you took $60,000 in depreciation. So the quick math shows that the possible cap gain plus depreciation recapture, 1031 exchange may defer capital gains and recapture if strict rules are met. Timing and structure matter before closing, which we talked about. So you want to talk to a CPA. Rental sales can trigger a more complex tax result, but essentially you have the cap gains that you're going to have to pay on, and you have the depreciation you're going to have to pay back.
Yep. So you have to, they will take that into consideration on what they're going to tax you, unfortunately. But let's talk about if you inherited a property, because this is, and there's a lot, I mean, this is a very simple example, but there's many ways you can inherit a property. If you do it in a trust, it's different than what we're talking about now. So let's just say it wasn't in a trust, it's your parents' house, and they just leave it in your will for you. So what would be the example of that, Frank?
Well, essentially, so you inherited at a value of $410,000 and you sell it at $430,000, and the selling costs are about $20,000. That's why it jumped up to the $430,000. So the quick math, the things that you should know: inherited property is usually about basis, not just sales price.
Right.
So that gets into step-up basis, and we won't get into that because we could explain that and go down that road, but it's something to look up. But that's the most important thing, is it's not just the sales price, it's about basis.
Right.
Taxes can be much lower than sellers expect. And this scenario surprises people in a good way usually. But it depends on how you have it set up. And this is where probate comes in.
Yeah.
So, this is why it's really important to think about what you have. Do you have a trust?
Yes.
Do you have your property in a trust, or do you not have your property in a trust? And if you want to leave it to your kids, there's benefits to having property in a trust.
And
again, we can do a whole nother segment on that itself.
Something I didn't know when we moved to South Carolina is, so when we were setting up our will, we got the copy and everything, and he's like, okay, I'm going to file this at the courthouse. And we're like, great. So if something happens to us, they can just go to the courthouse and find it. And he's like, no, not that simple. You actually have to have the original. It doesn't matter if it's filed at the courthouse here. You have to have the original document. So definitely keep that someplace safe. Have somebody else know where it is and how to access it. But that was something that surprised me as well. And then a lot of people that are our clients inherit a property and they have not been through the correct probate process, and they find out the hard way that they are not actually allowed to sell the property yet. So we will ask you for documentation when you've inherited a property, just to make sure that everything's been done legally that needs to be done, and you can actually sell it at that point. So it gets a little complicated for that, but that's something to know. If you do inherit a property, there are steps that you have to take before you just put it on the market. And then also talk to your CPA and get an idea of how much your taxes are going to be for that.
Yeah, it's really important that you follow the right structure. And that's why it's important to have a good attorney and not cut corners to make sure that you're setting everything up correctly, so that you can avoid probate and you can make sure that your family isn't left paying some huge tax bill. This is also why it matters where you live. Yeah. Because tax rules change by state.
That's true. Inheritance tax can vary.
So these tax laws change by state. And so you need to know what your state tax laws are on inheritance tax. They're putting, I think they haven't passed it yet, but they're trying to pass. I'm not going to speak too much on this because I'm not familiar with the whole thing, but they're trying to pass an additional tax in California around this subject. So you really need to pay attention and understand exactly what the laws are in your state. Really, not just if you live there, but if you own property there. So before you go to buy property in a state, you need to understand what that state's rules are, because lots of states, you might change your mind where you're going to buy if you find out that state doesn't have.
I think a lot of people don't want to think about like something bad happening. So you just do things. You might buy a vacation rental in, I don't know, Wyoming or something, if you like hunting. So you might be like, I'm going to buy it there. And you don't even think about that. But that's a good point, that you need to ask those questions before you just dive in.
Yeah.
So, and then talk to, again, your tax person or your attorney, that would do your trust documents and set that up properly based on where the property is located.
Yes.
So let's talk about some ways that we can offset these costs based on what is considered selling costs that they will actually take off. Not all costs will be taken off what you owe, but these will. So do you want to go to the next slide and let's talk about some things. We all want to know how to offset it. So these are some basic things that you can do to offset it. Commissions that you pay, certain closing costs, like your attorney's fees, title related selling expenses, transfer taxes, other selling expenses. So what you should do is talk to your CPA. I say that to my clients all the time.
Yes.
Like, talk to your CPA, tell them what's going on, and give them your settlement statement and see exactly what you're going to be able to write off. If you forget to do it, you might be leaving money on the table. So you don't think about those fees as being something that can actually help you and be taken off of the basis, but you need to make sure to give that all of the information to the CPA. It might be a little more complicated if you file your own taxes, but be sure that you're paying attention to those if you are filing yourself. Now, while you own a property, you typically do improvements. A lot of people do over time. So let's go to the next slide and talk about some improvements that you could do to the property that could offset what you owe.
Do you want to go over what to gather for people, or no? Do you want to leave that go?
I think we talked about the closing statements. So this is things that have increased the original basis. So let's say you bought it for $300,000, but you did these improvements and they cost $100,000. So now your basis of where they're starting you at is $400,000. So that's very important, because that's $100,000 difference that you could be taxed on potentially. So some of those improvements are additions to the home, major remodels. Let's say you put a new roof on, you put a new HVAC, you installed a pool, you did any of major systems in the home, any restoration work that you did to the property. So things to upgrade, update your property can actually help you when you go to sell to offset those taxes.
And I think it's also really important to know this, because you wouldn't think to do this, but some records to save would be contractor invoices and receipts, permits and plans, project completion dates, before and after records, and total cost for each improvement. And that's important because repairs are not the same as improvements, but the more data you have, the more you can give to maybe reduce your taxes. Capital improvements could increase your basis, and better records can lower your taxable gain. So,
well, let's say that you own a property for 10 years. A lot of people forget all the stuff that they've done.
Yes,
like,
that's what
I put that in. Oh, yeah, I did, but they don't think about it. But if you go into your property with the mindset of any improvement I'm going to do, I'm going to keep it in this folder. And then you will be happy with your future self will be happy with you for doing that one day, because it will really help. Because I'm sure there's things that you will forget that you did to the property that could have helped offset your taxes.
That's right.
And so anything that you could do, I mean, Frank, you would be terrible at this. You would have nothing, no receipts.
I just want screenshots and in an electric file. But if you tell me to do this paper together, no.
I have all of our stuff organized. Don't worry. So
everybody knows that you have a. Well, I'm not going to go there. So I'm talk about your shoe bins.
Oh my goodness gracious!
I'm not going there. All right. So at the end of the day, keep good records, because you're not going to deal with this soon. It's going to be down the road, and you're not going to remember.
Yeah, and if you have paper receipts, where are you going to dig them up? There's so much that you do when you move, and you have. So trust me, we're in this process right now. You go through your closet, there's a million receipts and stuff. You're not going to go through each one. I mean, you're going to get overwhelmed. So just help yourself from the beginning and document those things along the way, because if you know this, that it's going to help you down the road, I think it'll encourage people to do it during the time that they own the property.
For sure. So, and you never remember the contact info of the contractors that did it or whatever.
A lot of people might just not know that it's possible to use these things to offset their possible
Well, most
gain.
people probably don't. I mean, how would you know?
And so that's why this is the point of the video, is just to quickly tell you these things so you can dive in deeper if you want, if it pertains to your situation. But it's things to think about, to either remind you of or maybe inform you of if you don't know. So these are all really important things. Now, things that will trigger you to call your CPA. And these are things that we tell our client a lot of times. So you want to put that up, because there's so many times when a client asks me and I'm like, here's what I know, but I'm not a CPA, call your CPA, or here's the situation you're in. You might want to call your CPA ahead of time. And so go ahead on this trigger list, and we can send y'all any of these slides. If you're like, I didn't have enough time to see that, or I want to re-look at that, just let us know and we can get these to you.
And if you see this later, just comment slides or text us the word slides, and we'll send you these slides. At the end, I have a cheat sheet we can review, but
our website is carolinacraftedhomes.com. We have a contact form there. So it's easy to get in touch with us.
That's right. And you can also get our other buyer guides, seller guide, investor guides that will help guide you through the process. And you can just fill that out on our page under the guides heading, and we'll make sure that you get all three if you fill that out. So
and we have guides on probate. I mean, we have guides on all of these things that we're talking about now that will go more in depth for you. So.
Yeah. We just want to make sure that you have resources to help you through whatever your situation is.
Yeah.
Okay. So common triggers.
Yeah.
Selling a rental or investment property.
Definitely.
Obviously, you took depreciation.
Yeah. Sounds good in the year you did it, but not when you sell it.
It's always great to get it. And then when you got to pay it back, you're like, no.
So annoying.
Your gain may exceed the 250 or 500K exclusion. You live there less than 2 of the last 5 years. The home was part primary, part vacation, or part rental use. That's interesting. You inherited or were gifted the property, and you're considering a 1031 exchange.
I mean, these are all things.
We deal with those every day.
Yeah, we deal with all of these things. This is not just like pie in the sky. This is real world. We have clients that are in these situations all the time. So it is so important to have a plan before you're on the market and find yourself in a place where you're like, it's under contract. What do I do now? And then you don't know what you got yourself into, because you might accept a different price if you know what you're going to owe in taxes. Or you might plan ahead and say, okay, this year we're going to be hit hard because we're selling this property. We have a lot of gain on it that they're going to tax us on. Maybe we need to buy another property and do a cost segregation study on it to help offset that. Or maybe we need to 1031 exchange it into another property to offset that. So if you plan ahead, you can help offset it and not have that surprise huge tax bill. If you don't, there's a good chance you're going to be surprised, and maybe not in a good way. So that's why it's so important to talk to your CPA and plan ahead when you're making these big decisions on selling property.
And there's a couple things that I think are really important to note from this today. One is, this is really and this is not for everybody. Some of you should not buy a home. It depends on your personal situation. Many of you should buy a home. If you do buy a home, I think we're saying that we are advocates for home ownership. And the reason why is this is just one of the reasons, but the tax benefits, right? And the increase in money that you get to keep because of the exclusions.
But I think that if you're not aware of these options for you and you're just willy-nilly buying property, selling property, then you could get yourself in a pickle and you're not taking advantage of all the things that the tax code has. So we had to find a very skilled CPA in real estate that understands the tax law when it relates to real estate, rental property, short-term rentals, so he can advise us properly and we're not surprised at the end of the year, because that did happen to us in the past with the CPA.
But I would say that's true, but I would say there's something more important than that. And that is, you need to be your own advocate. The only reason I know what to ask the CPA is because I've read books about what I need to do. You need to be your own advocate. If you're waiting for someone else to come along and tell you what to do, you're in trouble. Don't let someone else decide or wait for someone else to tell you how you can save money on taxes. You need to spend the time to do it. It's well worth it. And it may not be fun or interesting to you, but is saving $500,000 in your lifetime interesting to you? It should be.
Well, not every CPA is a tax strategist, and there is a difference.
Yes.
Because some CPAs just go and they file your basic taxes and that's it. Some know how to strategize to save you money by doing certain things. And a lot of those things relate to real estate, whether it's your primary residence or an investment property. So it's very important to have somebody that you can trust to advise you correctly. Frank and I can help direct you with our knowledge and then send you to the right people to dive in deeper. But do you want to remove that side? One last thing before we go that I'll say that is big in our state and in the Myrtle Beach area, because a lot of our properties here are either vacation rental condos, second homes, or vacation homes, something like that. And the owner of it does not actually live in South Carolina. They are not a resident of South Carolina. They live in a different state. So the taxes when you go to close are very different than if you are a South Carolina resident. resident. So you're going to have essentially a
money withheld,
capital gains tax, money withheld at the closing table, and there's nothing you can do about it. So if you're not a South Carolina resident, you need to talk to your CPA ahead of time. This is why I tell everybody, because the attorney will ask you, how much gain are you declaring on the purchase? And these things that we talked about, the things that you put into improve the property, the money that you spent on closing on the property, all of those things can be used to reduce that amount of gain that you're claiming. So you need to talk to your CPA and get that amount ahead of time, because they will be asking you that question. Also, this isn't just a straight up tax. They're collecting it ahead of time, but you can actually get it back. So if you file taxes in the state of South Carolina, there is opportunities to get a refund of all or a portion of that money, but you do have to file taxes. And South Carolina is essentially saying, you are not a resident. We don't think you're going to file taxes here. So we're just going to take it from you ahead of time, and then you can file to try to get some of it back.
That's right.
It used to be 7%, and they recently changed that. And each year, the past couple of years, that's been going down. It was like 6%, and now it's just over 5%. I think it's 5.21% now.
My cheat sheet might have it.
It's something that you need to be aware of, because if you are down to the wire on your net sheet of what you're getting from that sale, and you don't count that 5% in taxes that will be withheld at closing, then that might surprise you and totally change things for you. So we want to make sure that you understand, if you're not a resident of South Carolina, there will be that extra withholding at closing, and then you can file your taxes to get it back. But be prepared on, this is probably the question I get most asked. Even though I tell people about this tax withholding at closing, they still ask me, how much should I declare as the gain when the attorney sends them the paperwork?
Yeah.
And I'm like, I told you, you need to call your CPA. I can't advise you of what you need to claim. That's
Heck
going
no,
to be
I don't want those calls.
No. I'm like, I can tell you all about it and where to go and who to call, but I'm not going to tell you an amount to put. That's for you and your CPA, or you, if you do your own taxes, to go through these items that we talked about that you can potentially reduce that basis. So just do your homework and be prepared for that if you're selling.
It's just important to know these things. And this is the final, it doesn't matter if we want it to be us. We want us to be the ones that you call, that you say, hey, I want some professionals to work with. But I don't care if it's us. At the end of the day, I just want you to use somebody. So make sure you vet the person that you're going to use well, and make sure that you trust them. But ask these questions. They should know these things. This is what we do all the time.
But I think a lot of times people don't know what questions to ask a realtor about these things, and they don't even think about a tax on them for selling the property, or what should I know about taxes when I sell my property. They just think all real estate agents are created equal until you get to the point of this type of thing, where some know what to talk about and some don't. And you might be an experienced investor and you already know all of these things. And we have a lot of clients like that. And we also have a lot of clients that see our videos and they want to get into investing in our area, and they want to get the ball rolling, and we can help advise you in that way.
That's right.
And because we've owned rental properties, long-term rental properties, short-term rental properties.
Well, I think that's a big distinction, right? So there's a lot of, and I'm not trying to dog other real estate agents, but if there's a lot of real estate agents out there who have never bought their own property, they've never invested in rental property.
Well, we all have to start somewhere.
So I'm just saying, like, it's never been a thing for them. So when you do it, it's totally different than if you haven't done it, and you just helps you gain experience. So I'm not saying that that's a prerequisite, but I'm just simply saying it could be a big deal. So be prepared, ask the right questions. Hopefully you're seeing this, and if you have questions, reach out to us. But that's our goal and our intention for doing these videos, is so that you can learn while we learn a little bit too. Most of this stuff we know, but sometimes we learn too.
It's always good to have a refresher.
That's right.
And maybe that's the way for y'all too, because how often do you buy and sell properties? For most people, it's not very often. And by the time you do it again, you might forget all these things. And this is a good reminder to look into this and do your due diligence.
That's right. So if you have any questions, reach out. The contact information is here. If you're watching this later,
We'll miss
please
y'all
reach
the
out.
next couple weeks.
Yes, we're going to be on family vacation. We're going to be gone. So we will be dropping videos on our YouTube channel, though.
Yeah.
Not a live video. We'll do those when we get back. But we will be dropping videos while we're gone.
Yep.
And we will look forward to seeing everyone when we get back. Is there anything
Hopefully
else
we'll
we
be
need
nice and tan and relaxed.
Yeah, relax is the most
I don't know,
important to me.
vacation from vacation. Usually we're going to come back to craziness. So
Yeah.
all right, y'all.
much.
Well, have a
All
good
right.
night and thanks for watching.
Take care, everybody.